Okay, so this is going to be the first video lesson going over several examples of how to trade one of the multiple strategies you now have access to. And this particular strategy, the titanium module T1, is a core trade that I gravitate and try and steer all new traders to, so that it gives a very good starting point with some simple to follow rules that give you the highest probability of finding successful trades consistently month in, month out. Okay, so let's just spend a minute or two and we'll just go right down through the construct and the setup of it. Okay, you can use this in any underlying asset you prefer, any vehicle you want. I have outlined here the Russell and the SPX because those are going to be the most advantageous from both a tax advantage perspective, but then also from a liquidity and volume perspective. The only other vehicle that will have more liquidity and open interest and volume will be the SPY. Now, you can absolutely do that when you're first starting out, but you have to understand that the commission load alone is going to really make it very difficult to capture any kind of meaningful profits when you're using it in the SPY. So, you can approach this with the SPY format, SPY format, just for execution's sake, and I recommend that highly to practice in the backtester mode. That's where we're going to spend some quite a bit of time here right now, exploring all kinds of various market conditions. But then after you get transition out of backtester mode, then go to simulated paper money mode. Then you may make that step. You may have enough confidence to jump right into the Russell or the SPX, or you may say, let me spend a little bit more time in the SPY to solidify some of these concepts. Okay, but any vehicle will work. The Russell and the SPX are the preferred vehicles that I like to use. Now, if we're going to use this in the Russell or the SPX, I like to allocate no more than $5,000 per butterfly. So again, this is an unbalanced butterfly, and you'll see that down here in the construct of it. And so when the trade begins, you may only outlay $2,000 or $3,000, but be planning on deploying up to $5,000 per butterfly to manage the trade and to calculate your both take profit and your max loss values off of. Timing of this, if you put this on every single Friday, looking at the monthly options first, and as well as using the weeklies as eligible candidates, you want to go out to 70 to 85 days to expiration for inception. Again, there is nothing in the world wrong, or I'm not implying that you cannot trade this at 30 or 40 days expiration, but going farther out in time gives you much more leeway to be wrong, and less dependence and importance on having to time the market just perfectly right. Okay, that's why you can enter these every single Friday with 70 to 85 days to expiration, or you could even say 100 days to expiration. Every Friday, you layer these trades in once a week, and you remove the trades when either take profit is hit or maximum loss is hit. And that's a very simple way to set up contingent orders to do that, so that you put it on and it closes. It either hits max loss, or it hits take profit, or you can adjust your variables as the trade starts moving in your direction. And I'll explain more what I mean about that deeper into the video. But here's a construct. The upper long delta, the upper long strike will have a delta no greater than 39, so 39 or less. The short strike will have your delta less than 26. Again, these are not absolute values. It can be 26.5, it can be 39.1, it can be, you know, I definitely want to keep it as close to 39 as possible, as well as 26 and 13. But these are the delta values that I use to set up the trade at the beginning. We're only going in the puts, and you can experiment with varying widths depending on if we're in low vol, if we're in high vol, and that should become a lot more clear, a lot more evident as we go through some of the testing here. Again, take profit 250, max loss 250. If this is in the SPY, for example, and say you're only deploying a tenth of that, because the SPY is 1/10 of the SPX, well then you obviously have to adjust your take profit and your max loss numbers as well. Now, adjustments. The first adjustment to the downside is the first day the market closes below the lower long strike, which is this one right here, right? Lower long delta less than 13. The first day that it closes underneath that lower long strike, the trade closes. We exit the trade. All right. On the upside, we do nothing until we hit 30 days to expiration, or take profit as hit, or the first day theta becomes negative. All right. If less than 30 days to expiration and the price is more than 2 standard deviations above the short strike, we'll roll the upper long 10 points down. It can also be referred to as a reverse Harvey, or we can roll some of the shorts up. It just really depends on your flavor. I will show both, but if we get a hard move up fast, I like to preferably roll the shorts up first. If we are just slowly kind of migrating upwards, then I may roll the upper longs down. Beyond that, no subsequent adjustments. Low volatility requires increased patience, and you can consider entering these on a down day. All right, so very simple, very straightforward. Let me minimize this. We'll bring over the option view, and we will say, all right, what point in time do we want to go back to? So I think first, right off the bat, let's go back to 2012. If we go back to 2012, we go to the end of the year, and let's just say this is what we're looking at. This is the market that you are looking at. So you have obviously a market that went up for the first 4 months of the year. You had a couple months of sideways. You had a couple months of downward retracement, more sideways. You know, you had some pretty decent movement at the end of the year, but at the end of the year it closed higher than what it opened the year at, and volatility was, you know, around this area here. So right off the bat, what we're going to do is we're going to go to 2012, the beginning of the year, in this area right here, and we're just going to trade a handful of cycles. Okay. And I think the reason for that is I can show you how I backtest, the steps that I follow. Okay, the steps that I follow, and how I approach the testing, test kitchen strategy development, if you will. And I apologize if the sound is a little bit different. I'm on a different computer right now, having some issues with the other one, so normally I don't have to minimize and bring this little toolbox up. I can have it on a separate monitor, but for now, for a few of these videos, we're going to have to just utilize this kind of format. So let's go right here and we'll say SPX. So right off the bat, what I do want to show you is, all right, let's just set the trade up across a few different underlyings so that we can show you exactly what I mean. So SPX, I want to look at the 5-point intervals. Now we're going to obviously go 70 to 85 days to expiration. So you'll see we have choices that we can make. If I want to go right here to 70 days to expiration, and I say, all right, well, we're going to go on the puts. I want my upper long to be less than 39. Okay, so that's going to put us right at the 1250 put. So I'm going to purchase one. We're going to go less than 26. So again, we're going to just come as close as possible as we can. And that's the starting format, if you will. So right off the bat, we'll do that. We get a nice positive theta number. Trade's going to cost us $3,000 in margin. We have flat delta, and this is what it looks like. So resume this. Okay, so this is how the trade starts out. We're under the market, so the whole entire structure is under the market. It's an unbalanced butterfly, meaning the wing widths here for the put debit spread is different than the wing width for the put credit spread. All right, but we still have a very nice flat T plus 0 line for a $3,100 trade. We have ample profitability of making our 250 target profit, risking 250 maximum loss to do so. And you'll notice that over the next 35 days, as long as we stay within here and here, we never experience any drawdown. And secondly, the design of the trade is never going to let us reach that maximum loss to the upside. So you never have to worry about any danger whatsoever of losing this to the upside, because at the outset you're already risking less than your maximum loss on the trade. All right, here's our maximum loss. If we said it was 250, well, right at the beginning of the trade, when the trade is first open, we hit to 250 at about this area. Over the next 35 days, you don't hit it down till you get to about this area, which by design, that's right around that lower long strike. Okay, so if we look at that in the SPX, it's a $3,000 trade, correct? Well, let's clear the trades and let's go in here to the Russell. All right, so we're going to go same thing, 70 days to expiration. Let's change this to 10-point intervals. And we will say same kind of approach. Buy one, sell two, buy one. Flat delta, positive theta. This is a $2,000 trade. All right, but it gives you the same kind of structure and the same kind of design. You've got a good flat starting out T plus 0 line. You've got 35 days to expiration where you will more than easily have the opportunity to hit your target profit. And if you wanted to start this with double size, because you're in the Russell, sometimes you'll be able to do that. You'll see you're still $4,000 trade, well within your $5,000 capital allocation, but yet 35 days from now, we more than hit our 250 target profit. And here are my thoughts on that target profit. Okay, so here are my thoughts on that target profit. When you have obviously plenty of opportunity to capture some gains on a trade that you're putting on once a week, all right, now you get a little bit of cushion built into your account, and you can say, all right, well, once I get $250 worth of profits, maybe instead of just quickly closing it, maybe I will just manage it a little differently. Again, that is up to each individual trader, and that is what you have to determine is aligning with your comfort level. Okay, so you can see right off the bat there are subtle differences between the Russell and the SPX. So lastly, let me just come over here to SPY, and you'll see that we can use the same expiration cycle, 70 days to expiration, and we will say we'll use 1 point intervals. We will just follow the same exact construct. Lower than 39, so we'll buy one here, come to 26, and come to 13. All right, now please notice that the delta value is still relatively negative, but your theta is 1/10 of what it is with the SPX. So to match apples to apples, you would have to do this. All right, so see, you get about the same trade, but to match the delta or the theta number, you're going to be a lot more positive on your delta because you're purchasing and you're transacting 10 times the amount of contracts. All right, but for learning purposes, when you're starting out, this is this is a $300 trade. If you are listening to this video, you've already spent this pretty sizable amount of capital to enjoy some private one-on-one mentoring, as well as access to everything that's in the community. So a $300 trade, I'd probably be safe in assuming, is going to be pretty insignificant for you. So, but you'll notice it's going to be the same management. So if instead of 250, we were saying I'm only going to target 25 and willing to risk 25 to do so. Well, you'll notice you're never going to reach that to the upside. So you can go to sleep for a couple of weeks, or you don't have to micromanage this intraday because you have no risk of ever hitting maximum loss on the upside, and you don't ever reach your maximum loss until you get under the shorts. Immediately as soon as the trade is open, as you build a little bit of time in the trade, that gets pushed out farther and farther until you are getting closer to the lower longs. Okay, so again, that's the differences between the three different underlying vehicles. So let's just go through and let's just walk through a bunch of these trades. We're going to start out in January. We're going to say, if this is the market that we are looking at the time, we've already seen where we go straight up for several months. So let's just see how this trade would react, and following these guidelines, what it would end up doing and how it would end up performing as the trade develops. Okay, so 70 days to expiration. We'll come in here at 39, we'll buy one. 26 sells two. And 13 buys one. All right, so that's how it's going to start out. And if we want to remove some of this upside, or if we want to, if I'm risking 250 maximum loss on this whole entire trade, I don't mind if that starting value is a little bit, closer to, say, halfway there. And if I wanted to do this, I could say, all right, let me get rid of that. and I'll just bring it down 1. You'll see that that brings it up. So in order to other way here. That's what I wanted to do. All right, so now instead of 280, that might be a little bit too much, so what would we do? Well, we could do something like this. And then that moves us to 240. We could $90. So you see, you can just experiment with moving these wings around, but you know, I wouldn't mind this being all the way up to about $125 on the expiration risk profile, so that when we start out, there's already that kind of pre-cushion built into it. So let's just leave it like this. That gets the upper long under 39. It gives this one under 26, and it puts this one you know, under 13. So convert the trades, and we can say, well, it's Friday, there's nothing to do. Now, a couple of thoughts about backtesting. Please do not backtest one way and then think you're going to trade entirely differently. If we are only looking at values at the end of the day, then after the market is closed, if that's when we're making our decisions, do not start monitoring this intraday, making decisions while the market is open. If this is the market that you're looking at after it's closed, all right, there is nothing to do. There's absolutely nothing to do. We have not hit target profit. We haven't closed under that lower long wing, all right? Hasn't closed below the lower long strike. We haven't reached our 30 days to expiration. We haven't hit our take profit, and our theta has not become negative yet. So, you know, in the beginning, you really don't need to do anything for the first several days while the trade is building. All right, so we'll just look at this again, nothing to do. And here you go, 1 week later, and this is where it takes a little bit of, it takes a lot of discipline to make sure you're overlapping your trades and you're not confusing them, but you have the quarterlies that you could put on your next trade, 78 days. You could come out here to 98 days if you wanted, but every Friday you're loading this and you're putting this trade on. All right, so nothing to do here. We're not 30 days to expiration. I'm not going to layer multiple trades right now, but just understand that if you do, then you create and you give each one of those trades its own separate account name and identifying numbers so that they do not get confused. All right, so we'll just go another week into the future. All right, so we are still theta positive. We haven't hit our target profit. We haven't reached 30 days to expiration, and we're nowhere near that lower long strike. Okay. Now, a couple of thoughts on the 30-day expiration mark. If you have not hit your take profit and you get your 30 days to expiration, at that point, then you begin considering either being content with lower profits or you having more risk that's put on this trade as gamma begins to become a lot more impactful. But you'll see here, you're up $95. The market's essentially done what? We put on here and it's gone straight up, right? We put this on in January 6th. Here is probably right in here. January 6th is this next day. And we've gone from the close at 1277. We got all the way up to a high of 1333. So, you know, we've had more than a 50-point move to the upside. And yet the trade is required nothing on our behalf. We'll go through a few more days, see if we are at our target profit, and we are not, but see what it's doing. It's just continuing to move higher, 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 higher. We're not 30 days to expiration, therefore we just keep rolling forward. Now, if theta becomes negative, which it has not, that's when we would make that first adjustment. And what is the adjustment? Roll the upper long 10 points down, okay? No adjusting until 30 days to expiration, or take profit, or the first day the theta becomes negative. Once any one of those three conditions are met, then you make your first initial upside adjustment. And all that is either rolling the upper long down or rolling the short strike up, okay? So we're getting close here, so let's just roll forward a couple more days. All right, so we're 30 days to expiration. Here's what our trade looks like. We're way far away from where our profit tent is at, and yet you'll see we really have essentially no risk at all of losing this trade. And I'm always advocating and always insisting that you focus on mitigating your risk first and foremost. Is every trade going to hit target profit? No. But is every trade going to hit a maximum loss either? No. And the reason this is designed and set up to perform the way it does is so that while you are gaining these wonderful lessons in all the different market conditions, you're protecting your capital all along the way. And when you do that, some months you're only going to maybe pull out $40 or $50 or $100. Some months you may have a small scratch even, break even, small losing trade. But I think if you follow these guidelines and if you make these your own, unique to you, it will be highly unlikely you'll ever have to take a full max loss unless it happens that the market moves right after the day you put it on. And I'm going to go to that example next and show you how that can happen, okay? But it doesn't happen that often, and when it does, you close your trade and you move on for the next day. I don't know why that keeps popping up. It's getting a little annoying. So 30 days expiration. So your theta is still positive. You are still, relatively delta neutral. You're not up, you're not down, you're essentially break even. So what has the market done? Market has moved from here on the 6th from a close at 1277 to up here at 1350. So almost 100 points. In my opinion, that's a pretty strong move when now you'll notice all of your legs are more than 2 standard deviations out of the money, all right? This upper long right here, these shorts right here, these lower longs down here are all more than 2 standard deviations away between now and expiration. So that is a very comfortable position to say, all right, I'd have no qualms with rolling one of these short strikes up maybe 10 points or even 20 points. But when you do so, what that does is it takes this position that has 35.90 in true margin, true risk into this position that now has the same amount of risk, all right? No, that's not right. All right, existing is this, 35.90, we'll close that. We'll hit both because that's going to model the adjustment 45.38 is a new risk, but see what that has done is that's taken this blue profile, which is your original unbalanced butterfly, and it's taken one of these shorts and it's just moved them up. And when you do that, see what you have done is you have taken the T+0 line from the blue, made it red, so you've incurred a little bit more downside risk that's more than 2 standard deviations away. It's 10% move down, but by doing so, you have now created a guaranteed risk-free trade to the upside. So let's convert that. And now, well, you've still got $38 of risk, but then we would move those up a little bit more. So let's do, we would say instead of just 10 points up, maybe we would go 15 or even 20. Again, it's, you know, it's unique to you. These are the guidelines. These are not black box, be all end all set of rules. They're what you have to make unique to you. I probably wouldn't do that just because that's a little bit too aggressive, but that is one maneuver. The other maneuver is rolling this down. Again, if we did 10 points there, what that does is that further brings that expiration line up. If you went 20, same kind of thing. And what I will do is I will show you, I'm going to roll one of these up 15 points. All right, because now by doing so I have taken essentially most all the risk out, but still given myself opportunity that if we get any kind of retracement back, I can more than hit my target profit. All right, now remember, every cycle is not always going to have a almost 100-point move to the upside. In fact, after we close this one out, the next cycle is going to have it moving sideways and even down some. So let me show you that. We'll go through, we'll just we'll just keep moving forward. We've got 21 days expiration. And one of the nicest features about this particular method is you'll notice that a couple of things. You can ride this into expiration. You can still put yourself in a very desirable position if the market retraces. I mean, we get a 10% correction in this market, and if this is the trade we have on, if we got a 10% correction, well, say an overnight gap risk, well, now we have more than hit our target profit when we close our trade up. Everybody else is crying. You are very content with the profits you're making. But additionally, if it doesn't correct and it just stays and it hangs out here for the next 14 days, or it drops a little or goes up a little, are you going to have a nice big month? No. Are you going to hit your take profit? No. Are you going to incur more commission load when these options expire? No. So you have protected your capital and you have mitigated your risk at every single step along the way, but in doing so, you've also given yourself an opportunity to not have to pay commissions to exit because you're going to let these expire. You're giving yourself extra cushion and extra built-in leverage to the downside in case it makes a big move to the downside, and you're still only looking at this trade maybe once a day, maybe every couple of days. There is zero need to be looking at this intraday at all. And you'll see that, all right, here we go, 9 days to expiration. We've got our $5,000 trade on. We're going to end up probably becoming a scratch or break even month. But please don't get hung up on, well, it didn't hit take profit, so it's a terrible strategy. This is a strategy you are putting on every single week, every single Friday, and every single trade is not going to move like this particular expiration cycle did. So from the 6th until the day before these expire, you moved from a close of 1277 to 1377, almost 1400, 130 points. That's not going to be a very common occurrence. So we expired those options and they're done. Now, the next cycle is we will go right here to the next day, Friday, and we'll say I can choose between 63 or 91. So let's just say we're going to go to 63. I'm going to set it up the exact same way. 1 at 39, 2 at 26, 1 at 13. Delta neutral, theta positive, $3,000 of a trade to start out putting us in this kind of a format. Okay, good flat T plus 0 line, 63 days to expiration. If we go nowhere, or if we just kind of meander around here for the next 32 days, more than ample opportunity to hit target profit with all of this potential profit underneath. All right, so let's just convert that, and we will separate these out. All right, so it's Friday, and we'll say not really going to be worried about it for the whole next week. I've got 63 days to expiration. I'm not going to worry about it at all. And here we go. We're already halfway to our target profit. We have $47 worth of risk to the upside. We still have plenty of margin in reserve to add to it for that first adjustment. And we haven't had to be, well, hang on a second, let's just double check. The lower long is 1270. We never got anywhere remotely close to 1270 on the downside. 1270 is way down here. Okay, so we'll go through to another week. And it's taking just a couple of extra seconds here to update. All right, and we'll go a few more days in time. But I think you get, I hope you're getting the concept and the idea of why this is so powerful, and yet it's so elegant and so simple that you already are building in less risk to the upside, while still giving yourself plenty of room on the downside for the market to kind of just roam around and breathe. Again, is it going to keep going higher or is it going to drop? We don't know if we're trading this real time going forward. All right, so we went from 13.99 to 13.70. We're starting to fall back. We're nowhere near this lower long. We're coming up on our 30 days to expiration, so we'll go forward. We'll go just a couple more days to that. Our theta has never turned negative. It has stayed positive the whole time, and there we're at. We're almost close to hitting our target profit. So what do the guidelines say? No adjusting until 30 days expiration, or take profit, or the first day theta becomes negative. Now, when you're first starting out, I'm going to suggest you strongly consider having resting orders on the server, so that if you know that you want to take $250 of target profit out of it, you work a resting order to close the entire structure with a good till cancel order at the closing price. If you end up paying $250 for the butterfly and you want to make $250, well, then you need to have a resting order to close it for $500, and that will offset the debit, and it will put your profit at $250 in your account automatically during the trading day. No manual intervention at all. But if the price is greater than 2 standard deviations above the short strike, roll the upper long 10 points down. And the easiest way to look at that is say, well, right here, this magenta line is 2 standard deviations away. No, we are not. So I'm not going to roll the upper long down, even though I'm 30 days to expiration. I haven't hit target profit, my theta is not negative, and I am not less than 2 standard deviations away. In fact, 2 standard deviations away is going to put me down here, and I'm going to be much greater of a possibility of breaking my maximum loss value. So this lower long, as you get closer to expiration, becomes a lot more like this expiration graph and less like that flat T plus 0 line. So 250 of a maximum loss is going to put you right around this area here, which is well in front of this lower long strike. Can that move happen? Yes, of course it can happen, but is it likely that it's going to have an 80-point move in one day? It's fairly unlikely. So there's nothing to do. Go a couple more days, but you'll see we're getting very close to that take profit amount. And there you go. 2 days later, you have realized a very nice profit. You still have 28 days expiration. At this point, what do? You either close it up and you are content with your profits, or it's automatically closed from your resting orders, or you say, well, you know what I can start doing now is I can say, I'll move this down. At the same time, I maybe move that up. And what that attempts to do is say, okay, I've got 20 days expiration, it's a $3,000 trade, I've got very limited risk to the upside. By making that maneuver, I say, I've removed some of my risk on the downside, I have locked in a guaranteed take profit to the upside, and yet I'm still leaving myself in a manageable, desirable position to say, all right, I'm going to take a calculated risk and say, I have now locked in, and that might even be a little bit much. You might only say, well, let's only roll that one to there. Which one was that? Oh no, never mind. Hang on a second. This is the one that I wanted, so. All right, that's what I want to do. So I can say, all right, I've locked in a guaranteed $123 worth of profit at expiration. I can still let the market roam around, and while it's not my full 250 of take profit, well, guess what? It's a guaranteed profit to the upside while still keeping a very nice flat T+0 line, and I don't get into any danger until I get way down to this area here for having to close the trade. If you're willing to take that calculated risk because you have confidence and you've also already built some cushion into your account by closing some winning trades for, say, the last couple of months, well, there's nothing wrong with making that maneuver, but you gain that confidence by doing it in backtester mode, practicing, sim trading, paper trading, small live trading, and you'll see that as the trade continues to develop, an 18-point move up one day and a 20-point move down day the next doesn't bother you at all because you've already locked in these profits. All right? 21 days to expiration, nothing to do. Theta will begin turning negative here at some point if we keep moving higher. At which point, then you make that decision. Do I close it? Or do I say, well, look at what happened. I kept my composure, I removed my risk, I stayed in a trade, and now I have more than tripled my take profit level. I've still got 14 days to expiration. Well, what do you think you would do again? Exactly what we did the last time. Start bringing these outer wings closer and closer into the short strikes. And every time you do that, you continue to further lock in that guaranteed profit while keeping the T+0 line as flat as you can, as well as continuing to remove margin out of the trade. So in my mind, it's truly the best combination. It's the trifecta method of adjustments, if you will. Once you have a very profitable trade that's doing this kind of business, up and down, sideways building, not this straight up hard trending bullish market like the beginning of that year was. All right, so are all of the trades going to be like that? No, but if you get skilled at making those maneuvers and those adjustments over and over and over again, you'll clearly be able to discover and see that it's a pretty resilient, quite robust way of trading that is, I'm not going to say it's easy because it's not. All right, it is not easy at all, but it is very, very simple. So let's just say this is where our condition we're in. We have 7 days expiration. I've already guaranteed I'm going to net at minimum 339 to the upside. I don't get into any danger until, here's the T+0 line. My 250 doesn't get risked until I get way outside of here. So what am I zoning in or keying in on at this point? Well, if I'm up $964 and I said my take profit was 250 and I was willing to risk 250 to do so, well, the reality says, all right, now I may let this float very slightly, but the first time I get down and I draw down 20 or 30% of these profits, I'm going to be gone. So maybe I'll say $600. Maybe if I get down to this area here, 1325, I'll close the trade. If I get up here to 1380, I'll close the trade. And then you might be so inclined to say, well, let me watch this a little bit intraday, or watch it at the open and then watch it at the close. And you'll see that you had a 15-point move down day and you just gained several hundred more dollars. You still are telling yourself you will close a trade at 1325, correct? That's what we just got done saying. So let's go one more day. And as long as we don't hit 1325, which we did not, but we're getting close, right? And this T plus 0 line is no longer flat. You have 3 days to expiration. If you want to jeopardize these profits, holding out for more, that is your decision. If you want to close the trade and be content with those profits, I think that's a very wise move. But you can also say, well, I mean, I can start pulling these up, and I can say, I have a true delta of plus 24. If I'm going to move these far out of the money, puts up to make that, cut my delta in half, well, that's what I have created, and I can say, now I can absorb an equal move one way or the other while still holding out for the home run trade, or the triple, if you will. The reality is if you're getting this close to expiration and you haven't already closed it up, please highly consider to do so. But let's just keep rolling forward. We'll go the day before expiration. I don't know if 1325 was violated, but let's just see if it was. All right, come on. And now, of course, option view will have to be a little bit buggy, right? You know, it is a fantastic software. It absolutely helps you build confidence and learn methods and see how options function and perform, but it is not without its little quirks and quibbles sometimes, for sure. So I do not believe that we hit 1325. Oh no, we did. Yes. All right. So perfect. Looky there. So that's what can happen. You're hanging out up here, getting greedy, holding out for more, holding out for more, holding out for more, and now you've just lost all those profits. So again, you have to put in place mechanisms so that does not happen. And if you are up, you know, you hit 1324 the day before. You said that's where you were going to close it, so why get greedy trying to hold out for more when you can see that it can, the angle and the slope of this T plus 0 line has changed drastically. But remember, here's the reality, and here's the mindset of the majority of traders. If you said you were going to target $250 and you were up $900 and you were tightening the noose to keep it around $600, now you're up $1,300. You're getting greedy because you want more, you want more, you want more. You see all this, you still got, you know, you can go from $1,400 to, you know, making another 100% more on top of that, all the way up here at, you know, 3,200. Well, that comes at the cost of jeopardizing those profits. So that's what you're up against. All right. So start at the 250, capture those profits, build some cushion, and I think what you'll learn and what you'll discover is if you just follow these guidelines clearly, disciplined and religiously without fail, I think you're going to find that this is going to be a fantastic starting point, whether it's in the Russell or the SPX or the SPY or Apple or Facebook, whatever the underlying vehicle is. It will help you begin creating and trading a method that gives you the highest probability of capturing profits. Okay, so this is going to conclude this particular video. I may have edits and I may put some additional add-ons at the end of it, but I just wanted to walk through a couple of different trades. Actually, let me do this. Let's go. It's kind of annoying me that it keeps flashing. I don't know why it's doing that. I don't know if it's just because I'm on a different computer, but it's getting a little annoying. Every 5 seconds that thing flashing up. But let's do this. Let's go to. So I do want to show you. Let's say that we go right back in here. All right. We'll say the end of July 2011. All right, so let's just say we go right here, July 22nd. Right before, it wasn't as significant as 2008, but it was a pretty harsh move down. And we're going to say, all right, nothing's changed. We're going to go either 71 or 91, 56. Any one of these cycles are going to work. But let's just say we're going to come right in here. Let's go the 91 days. Let's say, all right, we're going to go 1 at less than 39, 2 at less than 26, and 1 at less than 13. Delta neutral, theta positive, $3,000 trade. All right, so that's where we're at. Again, upside risk is 157. It's a little over half of what our true maximum risk is on this particular trade. And we'll just go to the following Friday. We're starting out at 1345, and 1 week later, what are we at? All right, I figured that was easier to just wait. We're at 1292. All right, so in 1 week, what do we have? We had this kind of move down. All right, we're not anywhere near this lower long. We're nowhere near hitting our maximum loss, but we should be starting to sit up and take notice because we've had a 50-point move down, right? I mean, we have moved from when we put this on to now under 1300. So let's go just a couple more days. And the point I'm trying to illustrate here is you have got to honor your maximum loss. Nobody likes to take losses, myself included, but taking losses is part of trading. You have to take the loss when if your trade is drawing down and you are hitting your maximum loss and you violate your trade plan and say, well, I really think it's going to come back, or no, it's overextended, or it's oversold, it's overbought, whatever the justification is you try and give yourself. Just understand you are reinforcing bad habits, and bad habits are what you do not need in trading. All right, you'll see that. So you continued. Now if you were unhappy when you were down $150 because you were almost to your maximum loss, well, now you're double your maximum loss. You just had a 60-point move down in one single day, all right? And yet, here's the reality. The reality is, yes, you just hit double your maximum loss. Are you going to be happy about that? No. But if you're only looking at this at the end of the day, or you're only able to make adjustments after the market has closed, you can't start back testing intraday thinking that you're going to perfectly time the adjustments. If the reality is you're only looking at your trades after the market is closed. That's how you need to test. And so if this is the trade construct you're in this time frame, and on this day, after you've already been in the trade since the 22nd of July, and we're just waiting for it to catch up. So sorry. Your theta is still positive. Your delta is now getting insanely positive, and you can see that it's giving you, clear signs that you are getting into the danger zone. There we go. So in this day, you have not reached your maximum loss. This is where you're at. You see that you're going to hit your maximum loss at 12:45, like 15 points away. You're going to hit your maximum loss. So at the end of the day, if you're looking at this, you have to ask yourself a question: are you prepared to risk a greater than a maximum loss if the market blasts through that area, or are you willing to say, I haven't hit my maximum loss yet, but it might reverse, or maybe I'll just preserve that risk since I've had multiple winning trades prior to this, and I'll just call this one a losing trade. It didn't hit my maximum loss, but you know what? I'll be content and close it up anyway. And that's what you gain just in experience of trading. You have no idea if the next day is going to be a reversal back up to 1300, or if it's going to drop down 1200 or lower. All right, but if this is the setup you're in and you're hanging around your short strikes, I would personally probably wait because I had not hit my maximum loss. But if I saw at the open, say the next morning, the market opens up and now I'm down 33 points at the open. The market opens up. This is after the first hour of trading. I'm down 33 points. We've obviously had this kind of a move in the first hour of trading. I'm at my maximum loss now. I'm absolutely going to be closing this trade because I'm honoring my trade plan, and I'm respecting. I'm having the self-discipline and the respect to say my trade plan says to close it. It's going to go in the loser column, so I'm going to go ahead and close it, even though the trade still has 78 days to expiration. You need to close it up and save your, consider saving your psychological capital for another day, for another trade. So if you do not do that, and let's just say I go all the way to 30 days to expiration, I fast forward a whole entire month. All right, let's go right to here. I think that this is going to be 30 days. Yeah, that's 30 days right there. So where are you at? You endured all of that drawdown, and yet here you are, not at your lower long. Did 1180 get violated? Oh yeah, pretty significantly. So if we go back to, this day right here on August 8th, and say, I did not respect that. Now here I am, I'm way out past my lower long. I'm 4 times my maximum loss. What are you going to do? And guys, these are the questions you have to ask yourself. And if you are unprepared, if you are unwilling to honor your maximum loss when it gets hit, then this is what you have to be prepared that you're going to endure. And this is not helpful to finding your path to make long-term consistent gains. All right, if your maximum loss gets hit, close the trade. Open it. You have another cycle opening 1 week away every Friday, and so I don't want to keep belaboring that point, but again, this is a pretty significant move that you go from 1350 to 1150, 200 points in a handful of days. That's about as bad as it gets, right? I mean, we haven't seen that in obviously 2008 we had much more significant event with the housing crisis, but 2011 was also pretty painful as well, but that is not the norm. And if you can just get skilled at being disciplined and owning your decisions from the get-go, then you can weather these kinds of storms. Then, as you saw in the beginning of the video, the second trade, you have the potential to more than blow away your target profit. So anyway, I don't want to just keep rambling on that, but again, this is how you set up, and this is how you test this particular trading structure, this guideline, this module, if you will. It's one of 8 modules that we're going to go through and we're going to run examples on. But again, try not, when you're starting out and when you're testing and when you're paper money trading and when you're small live trading, please try not deviate too much from these core guidelines and gain some insight, gain some knowledge, and ask yourself if it's valid, if it's viable, if it's worthwhile. I'm going to close this. If it's worthwhile, and you may find that, okay, I'm pretty uncomfortable having a 1-to-1 risk to reward. I want to lighten up my take profit to only 150 per butterfly, and I'm willing to let my maximum loss float higher to 300. Okay, that's going to be unique for every single one of us traders, but in the beginning, this 1-to-1 will almost 100% ensure that you will never blow up an account if you're following this, because the probability of profit and the strike rate and the win rate on this kind of a setup and this kind of a construct is much greater than 50% win rate. And even at 51% win rate following these parameters, this will have a positive expectancy, and that's the bottom line to all of this. Okay, so it's the simplest method I teach, it's the simplest method I share, it holds the most promise. You have the ability to trade this 52 times a year. You can deploy it in span margin futures options. There's all kinds of variations to it, but in the beginning, please do your best to try and just follow this construct as closely as possible. Okay, so I truly hope that helps. I know it's a long video. I'm going to try and keep the majority of these between 30 to 45 minutes, but just sometimes it's going to take some extra time. So that's the T1 core trade. So thank you so much for your time spent listening.